Welcome to the Explainer. Okay, let's jump right in. I want you to imagine walking into a massive supermarket, but instead of groceries, you're shopping for different types of money to fund your business. Loans, shares, retained profits. But here's the catch. Just like products sitting on a shelf, every single type of funding has a very distinct price tag attached to it. So today, we're demystifying the cost of capital. It's a fundamental concept that can literally make or break a company's financial future. We're going to treat business capital like inventory and figure out exactly how much it costs to keep the lights on and the growth engine running.
If you think the money in your company's bank account is free, think again. Honestly, this is one of the most common and frankly most dangerous traps in business. There's just this natural instinct to assume that if you generated the funds internally, or if you already have the cash just sitting there in the bank, well, it doesn't cost you anything to use it, right? But as the source material brilliantly illustrates, there is a hidden cost to every single rupee, dollar, or euro a firm uses, and if a business doesn't cover that hidden cost, it's actually destroying its own value.
So here's our roadmap for today. We're going to cover 1. The price of money. 2. Types and risk factors. 3. Calculating specific capital costs. 4. The ultimate blend, also known as WACC. And finally, 5. Funding the future with WACC.
All right, let's get into Section 1, the price of money.
So the textbook definition of cost of capital is the minimum required rate of return a firm must earn in order to cover the cost of raising the funds it uses. Think of it as the firm's baseline hurdle rate. If you're an athlete running a hurdle race, you absolutely have to clear that bar to stay in the game, right? Well, in business, this rate is your bar. It's the absolute bare minimum percentage a project has to earn to meet investor expectations and essentially keep the business alive.
Now you might be wondering, why does this hurdle rate matter quite so much? Well, it dictates almost everything a financial manager does. First up, capital budgeting decisions. Whether you accept or reject a brand new project relies entirely on whether its return clears this cost of capital. Second, designing the optimal capital structure. Basically figuring out the exact mix of debt and equity that keeps this overall cost as low as possible. Third, evaluating financial performance. If your overall return is higher than your cost of capital, hey, you're doing well. And finally, valuing shares and figuring out dividend policies. It's kind of the master metric that rules them all.
Moving on to Section 2, Types and Risk Factors. What exactly drives the price?
Okay, we've got to split these costs into two main categories. On one side, we have explicit costs. These are the obvious stated, out-of-pocket bills a company actually pays for procuring finance. Think of the interest payments you make on a bank loan or the physical dividends you hand out to your equity shareholders. It's cash literally leaving the firm. But on the other side, we have the invisible, implicit costs. And this goes right back to our earlier point about money in the bank not being free. An implicit cost is an opportunity cost. For instance, if a company retains its earnings instead of giving them back to the shareholders, the implicit cost is the exact return those shareholders could have made if they'd taken that money and invested it somewhere else.
It's actually really fascinating how the ultimate cost of capital is built step by step through risk. The whole equation starts with a baseline, the zero risk level or the risk-free interest rate, which is usually tied to government securities. But look, no business is entirely risk-free. So you have to stack a premium on top of that for business risk, which accounts for the chances of unfavorable things happening in the operating environment, like fierce competition, surging input costs, or new government regulations. Then, you add yet another premium for financial risk. This one is entirely about how much fixed cost debt a company carries. The more fixed interest you owe to lenders, the higher the financial risk for your investors, and because of that, the more return they're going to demand to compensate for taking on that risk.
All right, Section 3, Calculating Specific Capital Costs. Let's start pricing some options. First, let's take a look at the cost of debt, represented as KD. Now, debt is often one of the cheapest sources of funding, and this formula shows us exactly why that is. It's calculated as the interest payment multiplied by 1 minus the tax rate, all divided by the net proceeds of the debt. That little part of the formula right there, 1 minus the tax rate, is a little magic trick called a tax shield. Because interest payments on debt are allowed as a tax-deductible expense, the government is essentially subsidizing a portion of your borrowing costs. And let's be real, it's not often the tax man cuts you a break, so financial managers absolutely take full advantage of it.
But pricing the cost of equity, or KE, that's a whole different beast. Unlike debt or preference shares, equity doesn't have a fixed interest rate or some guaranteed coupon. It's based entirely on the expectations of the shareholders.
And because those expectations aren't neatly written out in a contract somewhere, financial managers have to use different approaches, like the dividend growth model or the capital asset pricing model, to estimate the rate at which expected future dividends should be discounted so they equal the current market price of the share.
So let's look closely at how the capital asset pricing model, or CAPM, solves this problem. It breaks the cost of equity down really cleanly. We're looking at three key variables here. First, a risk-free rate set at 8%. Second, beta, which measures systematic, non-diversifiable risk caused by macro-environmental factors. In this example, beta is 1.5. And finally, an expected market return of 15%. The CAPM formula basically says that the cost of equity equals the risk-free rate plus beta multiplied by the difference between the market return and that risk-free rate.
When you plug those numbers in, 8% plus 1.5 times the 7% market premium, boom, you get exactly 18.5%. This brilliantly illustrates how abstract market panic, or enthusiasm for that matter, translates into a cold, hard percentage. For this specific security, a company must generate at least an 18.5% return on that equity just to keep its shareholders satisfied and properly compensated for the market risk they're taking.
Before we wrap up specific costs, we absolutely have to talk about the cost of retained earnings, or KR. Again, if a company doesn't distribute its profits as dividends and instead keeps them to fund new projects, it still has to calculate this cost. Remember, it's an implicit opportunity cost. Generally speaking, it's equal to the cost of equity, because, well, the funds belong to those exact same shareholders. However, as our sources point out, if we're getting super precise, it can actually be adjusted downwards based on the individual shareholder's personal tax rate. That's because keeping the money inside the company saves the shareholder from paying immediate income tax on a dividend payout.
Which brings us to Section 4, the ultimate blend, the weighted average cost of capital, or WACC. Very rarely does a company rely on just one type of funding. They almost always use a mix. And notice here how we base the mix on current market value, rather than outdated historical book values. In this example firm's capital structure, equity is doing the heavy lifting at 53.3%. Debt makes up 22.5%, retained earnings sit at 17.8%, and preference shares are just a small slice over there at 6.5%.
To find the overall hurdle rate for the entire company, we use this master formula for KO, the overall composite cost. Now, I know it looks like a lot of letters, but it's beautifully simple. All you do is take the specific cost of each type of capital, which we just learned how to calculate, and multiply it by its respective weight, or that slice of the pie chart we just looked at. You add them all together, and you get one single blended percentage. This becomes the ultimate benchmark the company uses to evaluate all of its long-term existing operations.
And finally, Section 5, funding the future with marginal cost of capital. Okay, we really need to establish a critical distinction here. WACC, that blended rate we just discussed, is the average expected cost of the existing long-run capital structure. But capital is a scarce resource. As a company tries to raise more and more of it, investors naturally start demanding higher returns. So when a financial manager is raising additional funds for a brand new project, they can't just lean on the historical average. They have to calculate the WMCC, the incremental, marginal cost of raising the very next dollar of new capital.
Let's look at a practical example of raising new funds using marginal weights. Here, the firm isn't looking at its old mix at all. It wants to raise a further 500,000 rupees for a specific expansion. They plan to use a brand new mix to do it. 150,000 in equity, 150,000 in preference capital, and 200,000 in debt. So to find the marginal cost of capital, the manager calculates the new marginal weights, which are 30% equity, 30% preference, and 40% debt, and multiplies those by the specific after-tax costs. This gives them the precise new hurdle rate for this specific expansion project.
Which brings us to the core lesson, the ultimate takeaway of this whole explainer. The fundamental rules of finance tell us that a project should only be selected when its marginal revenue is in excess of its marginal costs. So I'm going to leave you with this somewhat provocative thought to consider for your own business or investments. As you raise more funds and your risk premiums start to pile up, if your marginal cost of capital eventually exceeds your marginal revenue, is your business actually growing, or are you just destroying shareholder wealth? Understanding these formulas isn't just dry accounting trivia. It is quite literally the difference between true growth and financial ruin. Thanks so much for joining me, and keep calculating.